Mark Mahaney, head of internet strategy at Evercore ISI, joins us now to break down some of these moves. And Mark, obviously, environmental factors are swamping almost everything else. But given that's the case, what is starting to, on a relative basis, seem like it's worth a look?
Well, this is a very challenging environment for growth equities, for tech equities. I refer to this as a pincer movement, with rising rates and slowing economies. There have been a few interesting outperformers that remind me and should remind us all that fundamentals still do matter. So Netflix and Uber, Etsy and Trade Desk, those four stocks are up 20% since the middle of the summer, since July 1st. Dramatically outperforming the market. Why is Netflix up? Because it's got a real catalyst ahead of it in terms of a new ad-supported business. Why is Uber up? Because they've just turned the corner on free cash flow profitability. So, I do think even in this market, fundamentals matter. And especially if you're willing to look out 12 months, we're going to look back on these and say, I should have stuck in and bought, I should have stayed in or started to accumulate some of the best fundamental stories in land. And, Megacap has those. It has the Amazons, the Googles, and maybe even a Facebook. Just the risk reward on that, I think, is very attractive. So some of these names I still like and I'd still consider and I would still be buyers of.
When it comes to Google, to Alphabet, it did kind of break below its June low. It's certainly looking cheap relative to its own history and even to the market if you adjust for its cash and all the rest of it. Is it mostly just macro concerns when it comes to the why of its underperformance recently?
And this is Meta we're talking about, Facebook?
I'm sorry, for Google.
For Google. Well, I think Google's got a little bit of a tougher angle. So if we're going to get into the fundamentals on Google, the two things you want to think about are they were a major beneficiary of those Apple privacy changes that gutted online advertising ad tracking tools. And actually, that really helped Google. And Google's also really benefited from all this travel advertising spend. We just went through the summer of travel love, and Google was a great derivative off that. And so now you're going to have tough comps for Google, going into the beginning of next year. I don't like Google the trade. I like Google the investment, and I'll flip it. Meta to me is sort of more interesting as a trade, maybe not as much of an investment. It's hard for me to know 12 months out. But near term, I think you're going to have an acceleration in revenue growth because they're going to move beyond some of these really tough comps, just like we saw with Snapchat recently talking about an acceleration in revenue growth. You put an acceleration behind Facebook or Meta's revenue growth, you start showing margin expansion, and both Meta and Google are talking about cutting costs. The market responds very well to cost cutting at this stage, and it should.
Nancy, have any of these kind of moved into your target zone?
Yes, and I agree with Mark. I think the large cap names that we've been focused on and have added to over the summer and in the second quarter are names like Google and Amazon. Microsoft is such an obvious stock to talk about, but they just raised the dividend 10%. And Nadella came out and was very encouraging about guidance and where they're going. So I do think that you can make money in those stocks. You may have to extend your time horizon somewhat. But Palo Alto Networks is another example. Cyber has a secular tailwind to it. And that stock has done very well. And we still own it and still like it. It's one of our 12 best ideas.
Mark, just a quick word on Amazon. It actually has held up better, but didn't really participate in the upside in 2021. What's going on there? Is it really just kind of going to the incumbents and the size and heft of Amazon as defense?
Yeah, maybe that's it. The stock hasn't really done anything, Mike, as you know, in, I don't know, almost 2 years now. And by the way, that's come back to bite them a little bit in terms of they had to now spend more on stock-based comp to re-energize those engineers who could, did very nicely being underpaid with stock, but stock that dramatically outperformed for a decade. That's changed. So it's a different dynamic for Amazon. But anyway, going forwards, I think you're in a pace now where Amazon's going to see this revenue growth acceleration. Online retail was the first hit earlier this year because of inflation shocks and demand shocks. That means they'll probably be the first out. And I think you're going to see that with Amazon. I think revenue growth can accelerate. I think they've had so many hard-hitting costs come at them earlier this year, whether it was fuel, shipping, labor costs. And I think they'll start scaling through all of those. I mean, you just had unusual shocks at the beginning of the year. So I like the setup in Amazon. I don't think anything changes with cloud computing. And they still have the best mix shift story in tech. The fastest growing parts of the business, advertising and AWS, are the highest margins. Best mix shift story in tech. You want to be long Amazon as a trade and as an investment.
All right, Mark, appreciate your thoughts today. Thanks very much on a rough day.